Welcome back to another week of Money in the Bank. I'm here with Brett.
Hey guys, welcome back.
How's it going today, Brett?
I've had better days, but I'm excited to be able to talk on the podcast today, so we'll brighten things up.
Well, that's good to hear. It helps that, you've had a couple drinks in you now. Really setting the mood. Nothing says finance like having a mojito first,
That's
right?
right. Angela really smooths it over before we do these podcasts. It's great.
All right, so today we're actually going to be talking about one of our favorite topics, which is real estate. So that's something that we've really kind of dove into head first the last year. And I would say we've really learned a lot in the past year.
Yeah, so we started, in the last year we've started doing our own, investment properties, but we've been buying and selling houses now for the last, in the 4-year range, because we're on our second big house purchase now. Seems like we've been doing this constantly for the last, 3 to 4 years here.
Yeah, I really think, once you get to the point that everybody at the mortgage team knows you and processes your file pretty quickly, you're in a pretty good place in life.
Yeah, we've got a good peer group now of mortgage lenders and all kinds of, fun investors and things like that we are in the circles with now because we're looking at different properties. We're keeping our eye out there. We know what the markets look like just because we've been, looking for houses for ourselves for so long. And we, in the last, about 400 days probably have been investing in properties that we've been looking for and for financial gains for the future.
Well, and I would say that's kind of how this all started. We moved back to this area and we were living in an apartment. We're maybe we want to get a house soon. So I just started looking at Zillow and I just really became addicted to real estate and learning everything I could about it. So before we even bought a house or before we even bought a real estate agent on board with us, I knew really kind of our whole area. And I was like, this is where we can afford to buy the house we want at the right price. And this area is growing. And I really did a lot of that research kind of beforehand. So when we went to buy our first house, I knew, that we were either getting a good deal or not. And then that kind of expanded till when we were in our house, I was just so used to getting on Zillow every single day that I couldn't give that up. And that's actually how we found our first rental property. I was just doing my normal daily Zillow browse and I was like, oh my goodness, Brett, I found something that we could buy and there is such a low chance that we could lose money on this. And, kind of got you on board and we bought our first property and really that's just a cash flow dream for us.
Right, yeah. So, we lucked into that scenario. Well, half of it was luck, half of it was you, hunting it down every day. And you really turned, looking for real estate properties into a game. All right, because there's so many tools out there and so much data that is available to people today for free, right? We're not paying for any of this stuff, right? We're just out there on a free service looking at the information available, and maybe it's not the latest and greatest, right? Some realtors have access to, but it's what we can get for free, and looking at that information is fun, right? And if you're comparing it against it and looking at other opportunities that are popping up, every day or every week, it's kind of a fun thing to do.
Yeah, well, and I would say, we do still use a realtor. We love her. We think she's great. She really helps us negotiate prices, and she's very quick at getting everything set up, which has definitely won us some bids just because her response time is so quick. But it's nice because then we have access to the MLS, which has every listing. That's where Zillow pulls theirs from. That's where Realtor.com pulls it from. So once you have access to the MLS, which is also, part of, I say free, but you do pay your realtor when you use them at closing. But that's part of the service they provide. And just by having access to that and access to all the data, I literally probably look at 30 to 40 properties almost each and every week still to this day as we're growing our real estate empire. so to speak.
Yeah, and some of those are probably houses for us as well too, but we're not looking to move anytime soon either. But
No, but part of it too, and I don't want to go on too much of a tangent about single family homes, but as I kind of look at other houses in the area, it's helpful for me to kind of compare and be like, these are the upgrades that are important, so we can kind of add it to our honey-do list. And we like to do a lot of the work ourselves around the house, but keeping your house updated, then if and when you go to sell someday, it'll just help it sell quicker, But, kind of going back to real estate, so I think the reason I really fell in love with it is it's all a numbers game.
it is. You could, and people have built like massive spreadsheets that compare every different area and how much data you could, or how many finances you could win or lose in different scenarios, and what the mortgage rates are going to be. Kind of the middle of the road is a little bit more, usable for the general population, right? Is taking some ballpark figures around like maintenance, and what are taxes going to be, and what are utilities going to look like, and what are the things that you're going to have more fixed costs for over time. But breaking those down into numbers for your area. So the biggest one I think that people kind of forget about is if you're going to invest in a rental property, for example, having like a vacancy period built into your math is really important, because if you for 12 months out of the year, if you have somebody in there for only 11 of those months, you're on the hook for that 12th month, and that's actually a pretty big chunk of change if you don't have somebody paying you for that full month, because you have the mortgage there if you have it mortgaged, or you have the utilities, or the lawn service guy still needs to keep it up, or maybe it's in an association of some kind or a condo and you're paying an HOA fee. Right, so you've got to pay all those fees and things, and you're taking that lost revenue. And there's numbers and math, and there's websites out there that will tell you exactly what that percentage is that you should calculate based on your city.
Yeah, so just to kind of back this up a little bit. So let's say you're like, okay, I'm ready to start investing in real estate. First of all, congratulations. You're probably making a good choice. I think it's a really good investment tool. But there are some things that you should know. So I've talked to some people, and they're like, so if I buy a rental property and my rent can cover the mortgage, it's a good deal. Would you say that's true or false, Brett?
I think you're going to lose money hand over fist in that model.
Exactly. So when you're going to have a rental, you want to make sure that not only can your rental income cover your mortgage, but you want to be able to make sure you can cover property taxes. You want to make sure you can cover insurance on the building. And then you also want to build in cushions for vacancy, for maintenance, and for property management. Now, I know if you're like us and you're kind of just starting out, you're likely going to do the property management yourself. But I will say it's still important to build this projection in, because life can change very quickly. And in 5 years, when we're only 5 years into a 30-year mortgage on our rental, we might decide that we don't want to manage them anymore. So I want to have that percentage built in so I can have somebody else manage it and still be making money off of it.
Right. And you should be able to look at the numbers and basically at the end of the day, if you've looked at all the math, and we won't go into huge detail about how the math is calculated on this podcast, right? But if you, at the end of the day, if you're looking at the numbers and they're like razor thin margins, right, then you should probably walk away from the deal, because you should feel comfortable that, in a medium to low chance of success or high risk or high problem area, or anything besides a tornado hitting the building, right, or the fire burning the whole thing down, if problems occur, like you need to replace the furnace, the air conditioner, and all this other stuff in the first year or two, that you're not underwater with it, right? So be a little more cautious with your numbers, and if somebody will come in there and buy it, but maybe somebody that didn't do the math quite as well as what you would be doing, right?
Well, and, especially for us as first-time investors, we had a finite amount, and we still have a finite amount of money. So, if we have to bring so much to close, then that means we only have so much for repairs. You might have people come in with an all-cash offer, and they have a little bit more in reserves, so their numbers look better. Some people, they're not looking to cash flow and have a mortgage. They're buying it with all cash, Well, then for them, it's just a tool to kind of get a monthly revenue stream. So different people buy properties for different reasons. If you're looking at it, when I look at properties, I'm like, I want to know that this is going to perform better for me than investing in the stock market, right? Because if it's not performing better than a mutual fund, which is, the S&P index is 7% historic average, then why wouldn't I just put my money there? Because there's no work over there.
Right, and this isn't a strategy that you want to jump into late in the retirement, or like when you're getting close to the retirement game anyway, right? Because you're looking at these gains over a long period of time, just like you wouldn't just dump all your money into the S&P, 5 years before retirement and just hope, everything goes well, right? Because things could tank there, things could tank with the real estate properties. So this is something we want to do maybe earlier or, in the mid game in your retirement roadmap.
Well, and I would also say you have to want to be a landlord, because if you don't want to do this, if you don't find this fun or interesting, you're going to hate it. It is a lot of work. Between the two of us, we kind of divide up a lot of the tasks. I find a lot of the properties and I do a lot of the number crunching because, let's just say your numbers were not super reliable when you tried to run them.
Oh, the first one we did was a lot better. I did some back of the napkin calculations on this other one, that were very highball. And it was great that you put those into a more detailed, spreadsheet and calculated everything out.
Yeah. But, we kind of divide up, and then you handle a lot more of the tenant direct communication, and you handle rent payments, and you handle maintenance requests, and then, sometimes we pass the maintenance on to, a plumber if we need to call one in. But some of the times we go over there ourselves and do it. So there is a lot of work that goes into these, and there's a lot of work that we have chosen to take on to save that property management fee. So if you want a hands-off investment, do not do real estate.
Probably that's going to be the case because your margins are going to be, unless you find the sweetest deal in the world and it's probably too good to be true, you're going to need to do some things yourself. And there's, like you said, there's some things that we've chosen to do ourselves, and there's some things that we've chosen to hire out because we're not at the stage where we feel the most comfortable doing those things yet. But, maybe in 2 years, then we would be doing those things. So, and to be more specific about how we're jumping into this, it's not like we're doing flips. We're not buying single family homes. We're buying things that are pretty nice in the first place, that have good margins for what we're looking for, things that aren't falling apart, things that don't need a lot of work. So we're getting into pretty some safe investments. We did buy a condo that was a great buy for us. There was very little renovations needed to be done, but we wanted to rip out the carpet that was from the 70s, right? It was that bright blue carpet that everybody had in that time period, and we repainted everything. We put in luxury vinyl floors that they had on sale at Home Depot or Lowe's or something like that we found good material for a good price at the time. And we had never done that before, right? We had never ripped out the carpet in our house or anybody's house and done any of that, or really fixed anything in any houses before. That was new to us, but that was something that was easy to do. Demo is easy to do, right? Laying down the floor tile was just snapping some of the pieces in together. They've made that really simple. And we've done a couple other things here and there, right? We've replaced the sinks and the faucets, and those are come to find out really super easy things to do. We did the whole process in under an hour, from not knowing what we were doing to watching a YouTube video to having the whole process complete immediately.
Yeah, well, and I think we can do a whole nother podcast about DIY. So kind of staying on track with rental specific. When we are looking for places that have been well taken care of. So maybe cosmetically we need to do some things, but structurally pretty good shape. And even cosmetically, even if it's dated, it's been well taken care of. So, even that horrendous blue carpet, although it was in great condition from the 70s, for being 30 or 40-year-old carpet, it was high-end 30 or 40-year-old carpet. We try to make sure that the units have been taken care of. Our most recent purchase was a duplex, and again, it was structurally, everything was like immaculate. It looked really nice. And we also buy in good neighborhoods. So, when you look at different websites, they will say like Class A, Class B, Class C properties. And I would say we try to go for Class B/B plus and up. Do you think that's a pretty fair assessment?
Right. Yeah, we don't have a whole lot of necessarily A's around here, I suppose. Some of the more affluent neighborhoods because, closer to the university that's by us. But most everything in the city is B, a lot of it downtown in the downtown area where a lot of the flips are. Those are more in the C category. But we're in the B plus territory for sure.
And, luckily we are in a rental environment where prices are very reasonable. It's very easy for us to find good deals. It's easy for us to make this happen. I can get on Zillow, and if we were not being super picky, we could have a property almost every week. But we are a little bit pickier than that. We are choosy about the neighborhoods we do and don't get in. And I always say, like, we wouldn't buy a property that we wouldn't feel comfortable living in ourselves.
Right. I mean, yeah, we're not in the California market, right? So our capital goes a lot farther than, some other regions of the country. Being in the Midwest in a great area, we can get away with, $100,000 buys you quite a lot here, right? And $200,000 buys you anything you want, basically, right? So we're not looking at half a $1,000,000 for a 800 square foot studio or something like that, right?
No, I mean, if we were going to $500,000, we would be getting like a 10 to 12 unit building at a minimum, right?
Minimum, yeah.
And we've even seen we've seen 12 units on our market for less than $500,000. Like, that's just the environment we're in.
I mean, we've seen entire portfolios from people that have been doing this, their entire career, being only like $1 million or between $1 and $2 million for like 20 to 30 different properties, including single family homes, whole complexes, things like that, right? So if you're walking in here with $1 million, you can make your terms basically.
You could own the city.
It's a nice market. Yeah, it's a nice market here.
So I guess, I know we don't want to get into all the numbers, but just kind of a high level, if we see a property, kind of what piques our interest. So, I'm on Zillow all the time. Luckily, I did grow up in this area, so I know the neighborhoods really well. So if I see, a neighborhood that I'm a fan of, and then I see a well taken care of unit come up, then I'll take it to the next level, and I look at rental prices. So this is kind of in two stages. Have you kind of seen online like the 1% to 2% rule?
What's that?
So that's where they say if you take your monthly rent and divide it by the price of the unit. So let's just say a $100,000 unit, and we'll call it a duplex, and then you could charge $500 both sides. So you would make $1,000 on $100,000. Well, that's the 1% rule. So they're saying you shouldn't buy anything if it's going to be less than that.
Mm-hmm.
But so you should aim for properties between 1% and 2%. So on $100,000, you should aim that you could either make between $1,000 and $2,000 a month in rent. And that's just kind of like a quick back of the envelope. Does this even fit in the realm? Should I even bother taking it a step further and doing a whole cash flow projection spreadsheet?
Right.
And, in our area, that is almost always true. I would say you'd be hard-pressed to find a property that wouldn't fit in that mold. But then you think about, other markets where single-family homes, I think, can be really tough. If you buy a single-family home for $200,000, well, it's going to be a lot harder to rent that for between $2,000 and $4,000 in our area.
That's very true.
I mean, nobody would rent it for that much.
Yeah, that's why a lot of the single-family homes that are going like hotcakes to, the flippers and the real estate investors that are, more of I wouldn't say slumlordy, but, between slumlord and strategic property investor are going for like the, $70,000 homes to $90,000 single family homes in the area. But then, yeah, you're not going to get a tremendous amount of rent out of those because they're just not in nice neighborhoods and they're not, quality homes that are being built out today.
Yeah. Yeah. So, that's kind of my quick sense check. Like, should I even take this a step further? And then after that, I look at what it's currently renting for. And then I take it a step further and I say, well, what could it be renting for? And that's where I've added a lot of value to different properties we've looked at, is saying, hey, currently they're only renting it for, $600. But based on all these comps, I think it could go for $675.
Right. That's the benefit of like looking at Zillow every day, right? Is you can learn a neighborhood just how you would like play The Sims or something too, right? You know what your little town is, you know what the important areas of the town are, and you get to know what the property values are, or how much the cotton candy guy is charging you for whatever you need to do. Maybe that was the roller coaster game. I don't remember.
Yeah, I think that was the roller coaster one. I don't think Sims had cotton candy.
Yeah. Sims always trap people in a bathtub. That was it. So whatever, yeah, you get to learn the market, you learn the area, and you get to charge, the right prices based on, you can jump in there and swoop in if somebody's trying to get rid of a property. If you can turn up the rent maybe $200 or something like that because it's way undervalued, then that's a big thing to consider, right? Don't just take at face value what they're doing today and saying that that's all you can get. Really take a look at the numbers, because the market will have changed, and the market in real estate changes at a different rate than like the investment market does with like the stock exchange. They're totally on two different wavelengths. They're not necessarily or in any way related causality wise to each other. So if the market tanks, the real estate market usually, will tend to stay on its own path and not tank with the real estate or the investment market.
And that's, partially too, kind of as the same concept as market, owning more than one unit or deciding to buy a duplex or a quadplex or, a 12 unit instead of a single family home kind of gives you diversification, right? Because you have more tenants, you have more likelihood of getting paid or not paid, but in aggregate, you're more likely to be getting paid. And, if you go and you buy a quadplex and you're like, each unit is $50 under value, you just added $200 to your monthly rental. Where if you have a single family home, it would be very hard to spring a $200 increase in rent on somebody.
Absolutely. And there's some other things to consider when you grow in that model as well, from like one door to like 12 doors, right? And that's, that's how I like to call it, is different doors for every unit that you have. You're building all these processes and workflows and how you're going to screen your tenants and how you're going to collect your rent checks and all those things too, for that one door. So getting into it and starting with one property and building out all these processes that you're going to do is a great way to get your feet well. And it would seem overwhelming for the first one because there's a lot of upfront work, but maybe it's only 20% harder to add another one there, right? Because all your processes are in place. You've already figured out how you're doing everything. You already have your leases written up. You just have to change the addresses on them, basically, and maybe a couple other things here and there. But it's basically all done for you, and you can just keep rolling it over and growing with very little difficulty from that original startup.
Yeah. Well, and I think a lot of people are like, oh, well, how do I even get the money for the first one? And for us, it was kind of an organic thing because we had been so used to paying off debt and then saving for a down payment for a house that we were just still kind of in saving mode. So we had this, money accruing, and we were like, well, we want to do something with it. And, we found this unit, which was great. But now, that we're on our second one, it's like a big snowball, right? So after you buy your first one, it only gets easier because now we not only can keep saving what we've been saving, but we have kind of like this extra money from our first property that gets rolled into that. So as you go and, you can get more properties quicker each time because if you're smart about it and you're analyzing all the numbers and you're looking at maintenance and vacancy on top of the mortgage, comparing to the rent, you're walking away every month with a portion which we call cash flow. And that's how much is going back into your pocket. And as you grow your cash flow, you're creating this big snowball essentially to, buy the next unit.
And there's a lot of support groups as well to help out with starting your first one, and getting into that snowball mentality, right? Growing into that snowball model. I know that YouTube is a big one. I always talk about how YouTube videos help people grow here. That gives a lot of tips and tricks. A lot of, some of your coworkers have been involved in buying real estate. Turns out like our dentist is a big person that was involved in real estate, and one of her hygienists, as soon as we started telling people, hey, we're interested in buying our own first property, and everybody was just like, oh yeah, we totally do that too. Like everybody just came out of the woodwork and was like, oh yeah, we've been doing this for years, and it's fun to talk about with them. But that's not something that they've ever talked about before. I had a couple coworkers as well, that owned, I think a fourplex and another one that had 2 single-family homes in like downtown Minneapolis. And so, learn from the people, like just ask around. And there's a lot of forums and things too. I know Mr. Money Mustache talks about real estate and investing in real estate a lot on their forums, and they have whole sections dedicated to that. Bigger Pockets is another great resource.
Boggleheads is another one.
Yep. And for property management and investing in properties, both, right? Because those are kind of 2 different work streams. If you're not just doing your own thing with one door and trying to figure it out yourself and finance it all yourself, right? It's all going to relate to you.
Yeah.
But you can specialize too, right? You could focus in property management and get your feet wet and, just take over for, let other people find the houses or find the units, and you can specialize in one area, right? That's a good way to get your feet wet in it. Or you could be an investor. I mean, if you're just sitting around with piles of cash, like I have some friends that, are in that situation, luckily, and they're looking for investment opportunities, but aren't looking to do a lot of the property management work for it, right? So everybody's kind of got a unique situation that they're in. And if you're specializing in what you think is the most fun and you enjoy, go after that. We kind of like doing both a little bit of everything, I guess, right now is where we're settling.
Well, and so, I would say a lot of people kind of get into it because they bought a starter home and then they're looking to move, and they're like, instead of selling my first home, I'm going to rent it out. And that's where I really caution people to run the numbers before you do that. Another common situation is if you're, dating somebody and you both have your own place, and then you take the leap and you move in together, you might opt to rent one of those out. And at that point, you're like, oh, well, I already have this, so I'll just rent it out. It's easy. And sometimes that will work really well. But I always say run the numbers first. If it doesn't make sense to rent it out, sell it. Get that lump sum of money. And if you really want to be in real estate, you can take the equity from what you just sold and buy a property that might be better suited to be a rental. I think sometimes people think they're stuck with what they have, and that was something when we were selling our first house, we briefly talked about, maybe we should just rent it instead. And as soon as I started crunching the numbers, I was like, you know what? No, because the township we lived in, which, oddly enough, we only moved 20 minutes, but it's a whole different township, whole different set of rules. Their non-homestead taxes, which is the taxes that you have to pay if it's not your primary residency, their non-homestead tax rate was so much higher that it immediately made it not worth it. And that's something I think a lot of people don't think about. They're like, oh, well, I'll just rent it out and this is my mortgage payment. And then they move and all of a sudden non-homestead kicks in and they're like, wait, where did this extra, $200 a month come from? And it bites you sometimes. So I always say, if you're thinking about doing it, check with all your local ordinances. For our rentals, we have to get rental license. Each year, we have to get them approved. They cost money. We have to have an inspection. So there's a lot of extra costs that go into it, and just make sure you're aware of all of them before you take the leap.
Certainly before you write the check. Yeah, definitely. make sure, and like I said with the processes, make sure you're comfortable, you kind of know what you're going to do, because you don't want to buy something and then not be sure what you're going to do, have to figure it out, while you're trying to get a tenant in there, or trying to figure it out and then trying to get a tenant in there, because once you've bought it, right, if you don't have somebody in there, that's your money going out the window, right? The key success to it, overall, that everybody says whenever you listen to anybody talk about it, is the turnover, to be able to keep people in the unit, or if somebody's leaving, get somebody in the unit like as soon as possible. Find that person, get them in the door same day. That's where all your money is made or lost, is in that turnover.
Yeah. Well, I think we could talk about this for hours. But, we're already at a pretty good point in the podcast, so I think we're just going to end it here. But we have so much more we could cover. We didn't get to ROI or cap rate, or what you should be sending maintenance or vacancy rates at, or how you should be calculating these cash flows. We could do another one about tenant screening and how to pick the right tenants, how to, keep them in there. We could do another one about annual leases versus month to month. There's so many topics we could talk about this. We love it. We love to talk about it. But before we waste too much time talking about it on the podcast, I want to make sure the listeners are interested. So if you liked hearing about this, if you like hearing about real estate, please send me an email or leave a comment on the website and let me know. Let me know that you liked hearing about this, and we will talk about real estate more on podcasts to come.
And what's the website?
moneyinthebankpodcast.com.
There you go. All right. Yeah. Come leave us a comment. We'd love to hear from you.
Hey guys, thanks for tuning in to this week's episode of Money in the Bank. Make sure to subscribe to us on the iTunes or Stitcher app so that you get weekly alerts every time we post a podcast. Or if you want, you can visit my website, moneyinthebankpodcast.com. And if you want to reach out with any questions or further comments, please email me at Angie@moneyinthebankpodcast.com. I look forward to hearing from you.
Money in the bank.